Hi, this is Macrodesiac. My name's David Belle, and welcome to Crypto and Grill.
Hi everyone and welcome back. It's Crypto Dantes here with the very capable Stig of the Pump. Do say hello, Stig.
Hello. I've had about 12 coffees today, so I'm raring to go.
Excellent. So look, we're here today with another fantastic guest. We say that every week, but they're all brilliant. We're looking forward to getting his perspectives on economics, trading, central banks, Bitcoin, and even his increasing brand and presence. Without further ado, it's David Belle. Welcome.
Hello. Cheers, guys. Thanks for having me on.
No, we really appreciate your time. You have got an increasing number of followers on Twitter these days, and your brand presence is really starting to emerge, and it looks like there's a lot going on. It would be great for the people that don't know necessarily who you are to give us a quick overview of what you do, your background in general, and your area of focus, and we will guide you through the rest of this episode and tap into that oversized brain of yours as we go through.
You saying I've got a big head?
I mean, your words, not mine.
My name's David Belle. I've been in financial markets since about the age of 18 when an advert on YouTube popped up for a retail broker, and I started trading off of demo money thinking that, oh yeah, this is the next big thing. I think I've told this story a billion times, by the way. But it pretty much came from being targeted on YouTube as I was doing my A-levels by the YouTube algorithm when you're searching for stock market and interest rates, stuff like that. The broker advert picked up my interests, and I started then. And then I went and did an economics degree, finished there, went into broking. I've always been trading throughout this time though. And then since then I've really just done things that can accompany my trading in the best ways possible. I think risk management is a massively important thing for me, and it should be for everyone. And so at that time when I was really developing, having some income while I was trading my own money was really, really important. It gives you peace of mind more and allows you to do more things and test more things out in your trading. Now I left broking back in January. I set up Macrodesiac as a response to loads of people telling me that really I should go into research. And I thought rather than looking at research roles or anything like that, I'll just do it myself and continue trading my own money. And this is where we are now. Obviously, I spout a lot of shite on Twitter. Some of it good, some of it bad, but that's it. That's where we are now.
Brilliant. And just let's so today we were hoping for quite a sprawling session covering central banks, the economy, even politics and sort of other economic philosophies as well. It'd be good to just start off on your call there. So trading. Would you say that economics is a necessary background to get into trading? Does it help? Does it give you an edge, or does it give you personally more of an edge over others? And is it something that your average Joe should consider? Because you quite often see these things in the media. I started trading Forex at 18 and now I'm a millionaire. I don't know whether most of them are scams or whether they're real, but what's your advice for anyone that's interested in trading and would like to think about a career in it?
I think, look, if you want to be a trader, I'm not sure why you'd actually want to, by the way. you must have
Gordon Gekko, right? It's the Wall Street image.
You must have something slightly wrong with you. But if you do want to get into it, you really do have to think of anywhere that you can find an edge. Okay. And I think that if you're focusing purely on one discipline, say, for example, technical analysis, you're missing out on so much more that drives the markets. So, although you might be a TA focused trader, there are things that you can get from other sides of the market, such as looking at economic data and sentiment and things like that, that can accompany your technical analysis. Now, I know loads of people just purely look at charts, and some are successful, most aren't. But I've found, for me personally, that having a combination of both is most definitely the best way to go. And I think that I lean more towards looking at the fundamental side of it, looking at macroeconomics and trying to piece together where capital is going to flow from and to. And I do that within a framework of looking at where the narrative is. So where people are talking about something, but where the data is actually saying something else. Because you find that when people are talking so much about a specific narrative, it's kind of hysterical. There's kind of either ultimate pessimism or ultimate euphoria, when really there's another story brewing that is a really cheap trade idea that you can make money out of. And that's the way that I look at it. And I don't feel like you can do that completely with just looking at technical analysis and chart-based trading. Although I do use charts in my views and to form my trade ideas.
Okay, and you're very sort of vocal on Twitter as well. If anybody either doesn't follow you, I would recommend following you. And if you're also not familiar with Twitter, I think it's an amazing source of content, research, insight. Obviously, don't take it as rote, but it's really good to challenge your current narrative or thinking. But a lot of that thinking that you put out there seems to also be reflected in your newsletter, which we'll come on to later. But the focus for a lot of the newsletter that you publish, typically about once or twice a week, is around trade ideas, the global economy, the central banks. I was hoping we could take a broader view at the moment and just reflect and get your views on what's the state of the global economy. There's a lot of debt, there's challenging growth. Where are we? What's the current temperature check in your view?
Well, I think that the global economy is most certainly slowing down. And although I'd love to say, yeah, we need to be short, that's not really the case. The reason being is that we've got central banks that are continuing to ease. Now, I put a video out just last week or the week before about Chairman Powell's not QE. And essentially what the Fed are doing is they're creating a narrative. I mentioned narratives before, but what they're doing is they're creating a narrative of their repo operations, which is a repurchase agreement in government securities, as not being QE. But what they've done is that. So let me just explain what a repo is. It's essentially a way to ease reserves in the open market. Okay, so the Fed do this in government securities mainly, but also they're doing it in mortgage-backed securities as well, and a few different other assets. And what Chairman Powell said back in October, I believe it was, or September, was that these repo operations, which initially started at just being overnight, so you loan basically overnight.
Sounds like payday loans for banks.
Kind of, yes. It's to ease short-term funding basically, and he said it was not QE. But if you look at the Fed's balance sheet since September, it's increased massively, like really, really huge. It's been a huge increase based on such a short time period, and compared to what's happened since the start of 2018 when they started easing it, and it's changed now from just being an overnight operation into longer term periods. So if you're holding and planning to increase the balance sheet for longer periods, how is that not QE? How is that not easing in some way to a larger scale? And this is what a lot of people were saying wasn't happening initially based on Powell's initial comments. But really, it is happening now. They've changed. They just did a $25 billion 42-day operation just yesterday, which extends past 2019. So this balance sheet is going to be elevated at least by some amount until past 2019. So it's definitely QE.
But why are people trying to conceal it then?
Well, you have to think about what is holding markets up right now. It is Fed liquidity, and why would the Fed be pumping money into the market if there's not an issue? If they don't need to ease credit, for example. So they're trying to create a narrative of, oh yeah, it's just a short-term thing. When really, no, there's bigger problems brewing. Many are saying that there's an insolvent bank out there. Now, the one that we'd straight away jump to is probably Deutsche Bank. And I reckon that it's about right, because they have really, really cut down operations in the US, and they've been moving certain bits of their capital into slightly different vehicles as well, which, for them, it sounds like they've kind of shit the bed almost. But yeah, this it smells very, very fishy to me.
Is this thing with the Fed something that's being replicated across the globe with other different central banks?
No, I mean the Bank of England have. Sorry, I just opened a can of Coke there. The Bank of England have maintained their purchases. So the Bank of England are very much involved in government bonds and corporate bonds. I think they own about £26 billion of corporate bonds. But this isn't happening to the same scale, or they're not undergoing the same operations as what the Fed are doing at the moment. No.
So let's take that to sort of a logical conclusion then. So, but what kind of risk does that put in then? Because you mentioned it seems like the Fed is undertaking QE and they're calling it not QE, but it looks like that. What sort of happens if central banks continue to pump money into the markets, or undertake massive bond purchases, which I guess is what they're doing? We spoke with Daniel Lacaille about this, and his view is just that bubble continues to grow, and at some point it will all come crashing down. Is there a sort of waterfall cliff edge moment where everything comes crashing down, or is there a way out of the kind of current expanding debt bubble that we have?
Well, one thing that I'm talking to Macrodesiacs about at the moment is actually that government's increasing their spending, which if you just heard, I think it was just 2 days ago, Lagarde, who is now obviously the president of the ECB, she said that she wants European countries to start turning the taps on in terms of government spending. Now, what happens there is that if governments start to increase spending, the price level increases, and central banks eventually get that CPI increase that they want. But the problem then that comes about is that central banks then need to raise rates. Now, with the state of these corporate bond markets and really, the price of yields in general, that will cause massive issues, maybe starting in emerging market countries where they're heavily indebted to dollar-denominated debt. And if interest rates start to rise based on this massive spending in the US, I know there's been a narrative of, we're going to go negative. I don't see it that way. I now see that because of this massive push up in fiscal spending that is occurring across the globe, or will occur, central banks are going to have to start increasing their interest rates to combat inflation. And it's essentially governments now monetizing debt, which is MMT, which is modern monetary theory. Okay, now a lot of MMT proponents will say, oh yeah, it doesn't matter, governments can just print because they've got a central bank there, but it really does when the government starts to monetize debt. And this is the issue that I see. I think there might be some contagion that could start in emerging market countries where they have borrowed in dollar-denominated debt, and those yields start to spike, so their payments become greater and greater. For example, I think Asia, excluding China, has 3.2 trillion dollars worth of dollar-denominated debt. What if the cost of that starts to increase, and some of these countries are going to really find it troubling to pay back? If you look at Turkey, for example, the year before last, they had massive issues with their debt markets, and I mean that's the way I see it going.
So where do you? So what happens at that point though? If we apply the 6-year-old test, so what? So what if countries struggle to start paying their debt? What's the sort of, again, logical consequence, conclusion? How might that materialize for you and I and the sort of retail consumers?
Well, you get a lock up in liquidity, don't you? If people aren't being paid back, credit risk spikes, liquidity risk spikes, and you see the market lower their bid to a time when you're getting 50 cents on the dollar or something, or even lower. It will be another crash, because if you find that many firms become insolvent, or even countries become insolvent, what happens to sentiment then? People shit themselves, and they just want to start getting out of the market. That's what happens, and that's the way I see it going, especially with debt levels this high. If you're increasing the cost of borrowing essentially globally because of increased fiscal spending, which might be very, very good short-term growth, but eventually, because of the amount of debt that's held, the cost of servicing that debt will be the issue that kind of breaks the camel's back, I think, if interest rates do rise concurrently with this increased fiscal spending.
So is this potentially the last final hurrah for central banks?
It's a tricky one. It's a really, really tricky one. I don't think so, because they're always going to try and manufacture their way out of it. I honestly couldn't answer that question. It's almost like trying to think of another color. You only really know kind of what is. You only really know what you know, really. I honestly couldn't answer that question about how things would change if central banks went, because I just don't know. I do not know.
No, interesting. So if we were to look at Europe then, so what's the situation specifically in Europe with the ECB?
They're totally fucked. That's the simple situation with Europe.
Is that an official headline from the FT, or
no?
Should we break that down a bit?
It's an official headline for my next newsletter, I think.
Okay, strong.
But no, I mean,
walk us through that then.
So, the ECB and Europe are very much stuck, because although Lagarde has said that countries need to start upping their spending to induce inflation, to induce growth, whatever, they don't have fiscal union. Okay, so she can't force. And by the way, she's saying this as an admittance that monetary policy has failed. She can't force countries to adequately and efficiently increase their spending to benefit the whole of the Eurozone. She can't force German taxpayers, for example, to foot the bill, because Germany's owed so much from other countries via Target 2. Well, it's displayed via Target 2. It's not necessarily that mechanism. And Target 2 is the gross real-time settlement system for the Eurozone, and it's how central banks borrow between each other, sovereign central banks, that is. So, the Bundesbank might borrow to, or lend to, the Italian central bank and whatnot. I don't want to get too deep into that, but we can do. But, it's too fractured. The Eurozone is far too fractured for any kind of real policy to be implemented to save them. I don't think the ECB would be able to raise rates because of this, which may be actually a good thing. But for the foreseeable future, I see the euro being a funding currency. So it's almost behaving like the yen, okay, where people are borrowing it to purchase, foreign equities, because it makes up the carry. So if you're borrowing at, I think it's minus 0.4%, which is the Eurozone base rate, and then you're borrowing at 1.5% in the US, you're making up, what's that, 1.9% there. Okay, so you're making up that carry based on the interest rate differentials. That's how the euro is going to be used, I think, continuing and going forward. But in terms of Eurozone kind of fundamentals, their industrial production is getting pretty soured. I see employment definitely decreasing based off of this. I mean, if you see Germany's industrial production, for example, has been contracting pretty heavily. I think they might have had a positive print just recently, but still, that's kind of an anomaly for the last year or so. And considering that Germany is the real powerhouse in Europe, it's very difficult to make a case for Europe having a big resurgence if Germany's if Germany's kind of stuck in the mud. But yeah, I mean, I don't see any real way back for the Eurozone. And I think if we want to delve into their banking issues, that's another thing we can talk about, because there was a piece written in the Telegraph just yesterday, which for non UK readers is a pretty well-known newspaper over here, and they actually have half decent articles in it. And it was from Ambrose Pritchard Evans, I think it was. He's quite a famous financial commentator, and what he said was that the Basel III banking regulations, which is to do with the amount of liquidity banks have to hold relative to assets and what collateral they basically have to hold, is likely to cause a 4.3 trillion, I think it was dollar or euro, I can't remember specifically, but a massive number, let's put it that way, a $4.3 trillion crunch where banks will have to sell off assets to make up the capital that is held against those assets. Now, if banks have to do this, they're going into even more unprofitable territory. And if you consider that Deutsche Bank is really in the shit, again, there's another massive systemic risk. But this all stems again, this doesn't stem from anything. This goes back to what we were talking about with the Fed in terms of, are the Fed really scared about this specific thing? And I've been mentioning the Basel regulations for years, because what Basel allows firms to do is to weigh their assets, internally weigh their risk. Okay, so let's say, for example, the capital increased that banks have to hold. Okay, but what they could do was, against specific assets, they could make a business case to the regulators that they only need to hold 0.5 against those assets. So although the capital has increased, they can reduce the risk weights, which means that it nullifies the required increase in capital. Okay, so we haven't actually, bank capital has not been affected since 2008, which is a really scary thing to mention. There's a lot there, sorry.
Yeah, no, I'm just trying to digest it. There's something that I think that would be really good diving in a bit further from what you said at the beginning of that soliloquy. Germany, if we just come back to Germany and Italy for a moment, and I think it is worth just going into the Target 2 issue, because it's not something that you see written about, talked about, or discussed. My high-level understanding of Target 2 is that, as you set out, it's a balance transfer mechanism, or it's a way that allows central banks to effectively fund each other. And at the minute, we have a deficit of approaching €1 trillion, I think, that are owed to predominantly Germany by Italy, Spain, Portugal, other southern European countries. Is that, what kind of risk does that present? And if there is a risk at all of default on that, do we face a situation where either Germany has to leave the euro and by default the European Union, and therefore you have a political breakup of the European Union? Or is there a situation potentially where Italy defaults and issues a new currency, say a lira, but effectively that becomes immediately worthless and we have a kind of a debt cascade? What's your view on the whole Target 2 Germany-Italy situation?
Well, in my view, I see it more as, I did used to think that it was more of a systemic risk. Now I see it more as a German sentiment risk. The reason being is that, as I said before, Germany's not going to want to foot the bill for other nations. Okay, and we're seeing the end of Angela Merkel pretty soon, and we're probably going to see a new wave of voting patterns, because we've had Brexit, for example, and there is some stark Euroscepticism. And a lot of anti-ECB sentiment in the Eurozone as well. So what I see happening is that the German taxpayer is going to be asked to do something that they really, really don't want to do. And that's going to rile them up into thinking, hang on, we have to reduce our surplus now to keep funding other countries. No, we don't want to do that. And what we're going to see then is a move towards German sovereignty, and German not wanting to be a part of the euro, them going it alone. that's personally how I see it based on this, because I think it's Germany, Netherlands, Luxembourg, and Finland that are the main countries that have a large surplus within the Target 2 system. And, they're really not going to, Germany's really not going to want to give up its status as a powerhouse in the Eurozone. And I think that's where it will start to head. Really, really do.
Do you think that then really starts to see sort of a seep into of, I guess, economic reasons seeping into political discourse as well? Because if Germany leaves the euro, does that presumably weakens their position within the European Union?
Yeah, no, absolutely. It definitely does. I think, in fact, it's interesting that you mentioned the political discourse, because Angela Merkel just recently, I think in the last few days, said directly to Macron, I can't remember the exact quote, but she pretty much said, "We're sick of having to mop up your mess," or something like that. Let me try and find it here quickly. And I think, yes, you're absolutely right. Economics is seeping into politics a lot, because what we have to remember is that the Eurozone is not an economic project. It is a political project, but it's been disguised as an economic project. Because if you consider how powerful Germany has become, yes, they were powerful before the euro, but in 2002, you notice how far their surplus went. They are essentially the powerhouse, and they don't want to give that up. They're too used to it now. They're too used to being this powerhouse. And with all of these spending rules that the ECB are now trying to, not rules, but the spending narrative that the ECB are trying to introduce throughout the Eurozone, Germany's going to be the one footing the bill. And they don't want that. They really do not want that, the German taxpayer. They're too proud of a nation. And it does just come down to really just sentiment, rather than any real economic rationale from a certain populace. It really does just come down to the sentiment, and they're not going to want to foot the bill for the rest of the Eurozone.
Interesting.
I was going to dive in. Are you going to dive in?
No, all yours. All yours.
So before we leave the European Union and take a look at the UK, let's talk a little bit about Deutsche Bank and HSBC. So what are the issues there, and what could go wrong?
Well, the issues with Deutsche Bank specifically is that they don't have enough return on equity. I think their return on equity is about 1.5%, which is just absolutely crap, let's put it that way, for a tier one investment bank. HSBC, I think I mentioned back last September, I believe it was, they introduced I believe it was a $50 billion facility for AT1 bonds, which is, I don't know if you've heard of it before, a co-convertible bond. So if the
assume no, let's give our listeners the benefit of the doubt. Of course, myself and my co-host know exactly what they are to a very detailed degree, but for the average listener, no. Assume no.
Right. So what a cocoa bond is that if the equity price starts to drop, the bond is then converted to equity to prop up the price. Okay, but the problem here is that when the equity price starts to drop, bondholders then start to hedge their holdings by shorting the equity price. So they start to short the delta. So what happens is that you get kind of a feedback loop of, shit, this bond is meant to prop up the equity price essentially, but these people holding the bonds are then acting against the interest of the bond instrument, and they then start to short it. And if you get mass shorts going on at one time, you get fucked, don't you? And the fact that these banks have issued so many of these AT1s could be a risk, could be quite a big risk. HSBC did issue a load, as I said, back in September. So you have to wonder why they're looking to do this. And surely it's down to firms seeing stresses.
And so now taking it back to the UK, full circle. So talk to us about the state of the current UK economy.
It's a tricky one. I personally think that we're doing okay. And I say okay very tentatively. because I think we're right on that line of shit. We could actually just start slipping into what Germany's like at the moment. I think services are down a little bit, they're contracting, which is obviously pretty much the UK's largest contributor to GDP. But we're still growing slightly. I think it was 0.2% for Q3.
0.3 this week.
0.3,
yeah.
Okay. Yeah, that's the one. So we're doing okay. Now, the problem that I see it's not actually a problem, it's actually a very clear problem, is for the pound specifically, is if we get a Labour government, because what they're going to end up doing is just kicking the can down the road for Brexit and that uncertainty, and currency markets do not like uncertainty. If we get a Tory government, then I'll be buying the pound. That's pretty much against the euro. That's pretty much a given, because it just makes sense to do so. It's a relatively easy trade for 6 months, I'd say. But Labour spending plans as well, and the Tories as well, to be quite honest with you, both of them are just ridiculous. And I reckon only about 10% of what they're saying in their manifestos will come to fruition. I think we'll kind of get a massive backtracking when we get to having to implement all of these policies. And we'll just be in the same shit, because what Labour are trying to do is to appease the swing voters that kind of lean a little bit left, or who are a bit sick of the last kind of 10 years of Tory government. And the Tories are almost trying to do that as well, but trying to appease the smaller business owners and the middle classes. I don't see any of them being really any good. I hate both of them. And also, I don't know.
But what about the alternatives?
There aren't any alternatives.
No, exactly. Yeah.
They're all shite. Lib Dems aren't even a party. Don't get me started on them. They're just a bunch of absolute weirdos just who've come out of the pub half pissed and have said, yeah, let's just go and write a manifesto. Jo Swinson, what's she doing? She was up a crane yesterday, smiling like a nutter. Don't like her. Green Party, no, don't like them. They have some good policies in terms of land value tax that I like. However, it's not the way that it should be implemented. And again, they're just identarian politicians, really. Just like the Labour Party. They're progressive nutcases. Don't like them.
But then what do you see for the future of politics in the UK?
Personally, get rid of them all. Introduce. So basically, I'm a Georgist. I think we've mentioned that we're going to get onto that bit. I'm a Georgist, and these.
What is a Georgist? Sorry.
So basically, Georgists agree with socialists that capitalism and basically certain monopolies provide stark inequalities. But then they agree with capitalists that socialism creates a government monopoly that rarely is better than private monopolies. Mm-hmm. So essentially, we look to eradicate the privilege, and I hate this word because it's been changed into some weird thing by left-leaning progressives, but to tax away privileges and only keep 100% of your wealth if it's from productive activity. So productive activity, what's that? That's taking risks yourself. So say you set up a business, there'd be zero corporation tax, zero capital gains tax. If you go to work and you earn income, you don't get taxed on income. However, the biggest way that people have they haven't earned this wealth, is by sitting on land. Okay, so let's say you buy a house in the centre of London when it was, the start of this century. Okay, government comes in and builds all of this infrastructure, drives up the price of your house by many, many millions. Okay, you've done absolutely nothing to earn that. It's been the total public and the government and what's going on around you to cause that price of land to be driven up. You personally have done nothing. Okay, and this is on the unimproved value of land, by the way. So if you do your house up and whatever, fine, you don't get taxed on that. It's purely on the location of the land. If you live say you live near a Crossrail station, for example, to put it into a more modern day context, the price of your land is probably going to go up more, but you've personally done nothing to cause that land price to go up. Okay. And the benefit of this is that taxing land is purely efficient because you can't increase the supply of land, which makes it perfectly inelastic. If you know about looking at supply and demand charts, graphs, from economics, a supply curve normally goes from the bottom left to the top right, whereas the supply curve for land goes vertical. So then if you change that demand in any way, you get a perfect change all the way down in on the supply curve, okay, which just changes the price. So if you consider that all the money supply that has been increased from central banks pushes into land, okay, which just drives the price up. So this is why you see problems with house prices, problems with high rent, for example, and this has all happened after 2008, when governments have undergone QE and low interest rates, because landowners know that the supply of land can't increase, so just sit on it. If the money supply is going to go up, that's why houses are so expensive. It's nothing to do with government policy or building more houses. We have more houses than households in the UK. So surely that means that supply outstrips demand, which it does. The problem is those people that just sit on land, empty houses. And if you were to tax those, you tax away the benefits of just not making productive use of that land. And that's the key. Land needs to be put to productive use and not just looked at as a rent-seeking tool.
Interesting views there. It's not something that I'm familiar with, so I think we'll take that away as a point of research. But thank you for the overview. If we just sort of hot on the heels of that, sort of tax reforms and other things that could be done, I think just to summarise your points, Labour, we've got an election coming up in the UK. A Labour government would largely be damaging on the basis that actually the printing of money would only get worse, and the nationalisation of all kinds of industries would make them effectively largely uncompetitive for the next kind of 10 years. A Tory government will keep things privatised in the form that they are, but will continue to print money as well, and as you said, appeal to those people that might be currently centrist leaning Labour. Regardless of sort of the outcome, let's assume for a moment that the outcome doesn't matter. What are the steps that the UK could take outside of Europe? So let's assume we go forward with Brexit, relatively close to the plan that's set out at the moment. What are the things that could be done to make sure that the UK remains competitive on a global scale in the face of all of these economic headwinds and challenges that we've talked about over the last sort of 35 minutes?
Well, become more like Singapore, for example. Okay, Singapore have pretty much a land value tax, but they're one of the most deregulated countries in the world. We're focused primarily on services. Why are we abiding by these really risk distortionary regulations that come out of things like MiFID II, for example, in the financial sector? Why are we abiding by these when they're actually creating more problems than helping? The financial regulations coming out of Europe are distorting markets so massively, and now alongside other things, of course, like central bank policy and whatnot, but they're distorting markets so massively that it's creating far bigger problems than any utility gained from it. And I know it's a reaction to 2008, and I know loads of people did things wrong in 2008. But again, 2008 was born out of government regulations. Okay, it was born out of governments pretty much underwriting banks. So why don't we just let banks fail, for example? Why do we need this regulation to underwrite banks? If bankers knew that they weren't going to be bailed out, then they wouldn't have undergone those crazy practices of creating subprime loans and all of that. It's crazy to me that people want more regulation from governments, which are so inefficient in terms of both spending and coming up with real practical, efficient solutions. That it just astounds me that people still want more government. It just doesn't make sense in my head. I don't know why. That's the way that I think we need to go, is to really deregulate and remove government interference in sectors that don't need it, because markets do tend to work themselves out better when there's no distortion from things like government subsidies, from increased taxes. Corbyn wants to introduce a financial transaction tax. Okay, what it essentially means, and I saw someone break it down on LinkedIn, is that he wants to basically tax the financial industry at 12%. That's what they worked out. That they want an added increase of 12%. That's how it works out when you look at the marginal tax of what the contribution to the financial sector to GDP would work out at. That's how much of an increase he wants. Now, is that really making the UK competitive when services are the biggest industry? No. So what does he want? It doesn't make sense. He wants growth, but he wants it all in the government's hands or something. Does he think the government is going to increase growth when really, it's the private sector that provides these taxes for the government? It doesn't make sense in my head. So this is why I think we need a total revision on regulations.
So what do you think is going to be the impact of this election on the City of London? Because on one hand, it could lose its financial services industry after Brexit as a result of banking passports, but on the other hand, a Labour government could change it instrumentally as well.
There's a big misconception with regards to passporting. We all know back in 2016 that there was the fear around, we won't be able to access Europe and whatever during the referendum period if we were to leave the EU. It's absolute nonsense, because 95% of the city's business is in wholesale financial activities and 5% is in retail. So that 95% of business isn't actually covered by passporting. Okay, if I am, I don't know, Goldman Sachs sitting in London, and I want to deal with, I don't know, JP Morgan that sits in Paris, there's absolutely nothing stopping me from doing that because of my client type or my customer type. Banks are considered eligible counterparties, which means they're pretty much outside the scope of a lot of regulation in the sense of what people understand regulation to be. Then below that, you've got professional clients, and then you've got retail clients, which, yes, they will be affected by passporting. So people that trade at FX brokers, for example, and are considered retail, they will be affected, but not the big banks, not the people that are doing most of the city's business. And if you're a retail broker, you can go and set up in Europe and just create a subsidiary. There's no issue. And you'll notice that this fear-mongering over the city losing tens of thousands of jobs, has that happened? No. I think it's less than 1,000 jobs have moved. And that's purely in back office functions most of the time. So it's a total shit show that people didn't recognise this sooner. And it was so easy to recognise as well, because if you've done your level 4, which is the regulation you need to be able to, the certification you need to be able to deal with in customer functions at any regulated entity, you'll know those 3 different client types, and you'll know the regulations behind them. And no one picked up on this. It astounds me, totally astounds me. So the other thing as well, if you're a fund manager, you can register your fund in Dublin or Luxembourg, but you can sit in London and have your practice there. So what's the difference? There's no difference whatsoever. It's just a load of bollocks coming out of people's mouths who don't understand anything practically.
Not that after that I'm trying to usher you towards an end, but I'm just very conscious of time, and probably our listeners are going to be thinking, when are they actually going to talk about anything crypto related? So on that, what are your views of Bitcoin as an asset class?
I I actually wrote about this I think it was last month or something. People always talk about Bitcoin as a store of value versus an asset class, whereas my thinking is that it can be totally both. The reason is because back in 2018, cash was considered the best performing asset class. So what do some people consider Bitcoin? Yeah, well, they consider it to be a digital currency, right? Whereas others consider it to be a store of value. It totally depends on your utility of it. Um, for me, I personally don't care as much. I just look to profit on the upside. Well, sorry, take profit when it's moving down, and make sure that I'm flat if it comes back to entry, and convert it into cash. I see it as just a trading instrument, like I see everything else. I don't really see it as, I'm not, religious about it. I think it's very interesting to see how a brand new asset class works within the wider economy and macroeconomic shocks and stuff like that. But for me personally, I just don't. Yeah, I don't really have a massively religious opinion about it.
Do you see it becoming more and more of a haven or a hedge against instability?
Yes, I think, for example, if you look at when China and Hong Kong was experiencing some issues, well, I mean, they still are, but we saw quite a lot of capital flows coming out, didn't we? And into Bitcoin. I think possibly, yeah, but again, it totally depends on your thinking behind it, whether it is just an asset class to trade or you do genuinely see it as a store of value. People have different reasons for buying equities, for example. Some want to look at the long term, whereas others just look to make money up and down. It just totally depends on what your horizon is, in my view.
And when you speak about Bitcoin publicly, you quite often say that you see a neat link between Eurodollar futures and Bitcoin. What's the sort of link there? Where does that originate? Is it just a something that's working at the moment, or is there something more fundamental behind it?
Well, my thinking is that it can show dollar liquidity. And a lot of people don't really look at the dollar side of the equation when they're looking at Bitcoin. I'm not sure why, but the only real macro link that I've found is to do with dollar liquidity. When dollar liquidity is up, then Bitcoin tends to rise. It tends to rise in value, and when dollar liquidity is down, it tends to fall. Recently, it didn't work very well, but from February to about August of this year, it worked really, really well. And what myself and someone else was doing was we were looking at the extent to which the volatility of Eurodollar futures influenced the price of Bitcoin, and we saw kind of a lag of maybe 32 to 48 hours on the moves. So if Eurodollar volatility spiked by a certain amount, I'm not going to say what it was because it might reduce my edge, but we would note down what happened after and to the Bitcoin price, and yeah, there was considerable correlation there. It's difficult to create a real causation for it, but my view is that it does come down to dollar liquidity.
Cool. Look, we are rapidly running out of time. This is, as you know, the Crypto and Grill podcast, and it would not be an episode without asking you the infamous question of, if all of the world's traders were coming around to your flat overlooking the Thames in London, which is where I picture you in some kind of penthouse, and you were hosting.
I mean, yeah, I'm looking at it right now.
you were hosting a rooftop barbecue to take care of them for the afternoon. What would you stick on the grill, and how would you look after your guests?
It's a tricky question.
You're not vegan, are you?
On the grill,
it's probably the easiest question of today. But yeah,
I'll probably stick Jeremy Corbyn's manifesto on the grill. I'm joking. I wouldn't. Let's just go for premium meat burgers. Is it Wagyu beef? Let's go for that. Wagyu burgers. Pure Wagyu burgers. You're coming around for a Wagyu party.
Nice. I think you probably have a Wagyu steak rather than a burger, but
no, we mix it up.
You can get Wagyu burgers as well.
Yeah,
nice.
I'm pretty sure I've had a Wagyu burger before.
Excellent. Look, it's been great having you on. Do you want to tell us a bit more about the Macrodesiac brand and what you've got coming up over the next 12 months?
Yeah, so Macrodesiac, what we do there is I come up with ways to look at the market that other people aren't really focused on. We operate within the same framework each time, which is looking at where the data doesn't match the narrative or vice versa. And we come up with the best ways and cheapest ways to action that specific idea, whether it is in ETFs or FX or equities, whatever. We go across all asset classes. And also there's a risk management framework as well that you can abide to, which really, really does help. There's a community of about 100 to 200 traders there on Discord. And yeah, it's a really, really fun thing to do, and it's not too long and boring. And yes, I do swear in it as well.
I think we know that's part and parcel with you. So, but we love you anyway.
You're the first guest. You're the first guest that didn't ask permission to swear.
Oh really?
Yeah.
Do you know what? I've done it so many times now, and everyone's giving me the same answer. So it's kind of like
Nice.
it must just be a common thing in the podcast now.
Yeah. So as well as that, is there anything else? I know you've got you have an occasional podcast as well, and you're developing a training course. Are they continuing, or are they one-offs?
Not so sure about the training course, because pretty much Macrodesiac is the training is learning via osmosis. But yeah, I've got a podcast, Macrodesiac podcast. It is on Spotify, Apple Music, and I've got a YouTube channel as well. Just Google Macrodesiac, and you can see all the videos that I've done with myself speaking to the camera and podcasts, and a couple of bits with Adam Webb as well, who is really big options market maker. He knows his stuff a lot better than I do. But yeah, you can check all those out.
Cool. Well, before we sign off, do you want to give your newsletter a quick plug? Let people know how they can sign up. And yeah, it's been great having you on.
Yep, just go on to macrodesiac.com. There is currently a discount running as well. And yeah, you can just log on there and check me out.
Awesome. If you're listening to this, you are the resistance.